Good morning. Cash home purchases have dropped to the lowest level since the pandemic. And what that means for Texas folks. All cash home purchases declined nationally in December of 25, reaching the lowest level since early 2020. And according to recent data, the share of buyers paying entirely in cash fell from about 30% to about 29%. And it's well below the peak rate from 23 at about 35%. And the primary driver is lower mortgage rates. So, with the 30-year fixed rate easing to roughly about 6%, many buyers who previously chose cash to avoid 7% plus rates are re entering the financing market. And at the same time, sellers now outnumber buyers nationally by approximately 47%, shifting negotiation leverage back towards buyers. So let's look at Texas markets, especially Houston, Dallas, Fort Worth, DFW, San Antonio, and Austin. The shift has meaningful implications. So let's look at some Texas cash buyer trends. And Texas historically sees above average investor and cash participation, particularly in Houston, in Dallas, in San Antonio, and in Austin, the Texas Triangle. And during 23 to 24, certain North Texas submarkets recorded cash shares in the 30 to 33% range. And I think that was driven by institutional build to rent operators, but also private equity backed rental aggregators, as well as fix and flip investors who are just targeting resale inventory. Now, with rates easing into the low 6% range, leverage is becoming attractive again. And that's particularly for investors who are focused on yield optimization. And cash still carries its negotiation power, and in select Dallas transactions, buyers have negotiated 10 to 20% below appraised value when presenting clean contingency light offers. However, the urgency premium has faded a little. What we're also seeing is that the use of FHA loans is declining in Texas. And national FHA usage has slipped from 15% to a little over 14 year over year, but Texas mirrors this pressure, particularly in higher tax counties. Key Texas specific affordability constraints. So property tax rates are often 2 to 3%. There's rising homeowners insurance premiums everywhere. And HOA fees have grown in master plan communities. So what we're saying is your escrows plus your mortgage insurance are pushing their cash to close in the $20,000 to $30,000 range. And in many Texas metros, FHA historically accounts for about 18 to 22% of finance transactions, especially among first-time home buyers in Houston and San Antonio. But payment sensitivity is limiting usage even with 3.5% down options. So for borrowers, the issue just isn't about the total monthly payment, but it's just about the loan itself, but the actual total monthly payment. So conventional and VA loans are showing strength. Conventional ticked up to about 78%, reflecting stronger borrower profiles and improved rate competitiveness. And Texas continues to show above average VA loan utilization, and that's particularly near Joint Base San Antonio, Fort Cavazos and Killeen, Fort Bliss and El Paso. And VA borrowers benefit from zero down payment, but also no monthly mortgage insurance. And you have a competitive rate since it's backed by the government. And in a stabilizing rate environment, VA and conventional financing are increasingly compelling alternatives to all cash deployment. So let's look at some strategic implications for Texas buyers and investors. And first being that leverage is returning as a tool. So when rates were 7%, cash was a defensive position. And at below 6%, leverage becomes strategic again. So preserving liquidity is going to allow portfolio diversification, but also to flesh out your emergency reserves and open the door to additional investment opportunities. And if you have a higher internal rate of return through capital efficiency, lower rates are only helping that. Smart leverage, properly structured, is going to enhance your optionality, is the point. 2, negotiation power has shifted, and inventory levels have normalized across much of Texas. And in Houston suburbs, as well as Dallas exurbs, financing contingencies are a little less punitive, and sellers are offering more concessions. And there's usually some inspection negotiations that are more balanced these days. And financing is no longer a competitive disadvantage, is part of the market we're in right now. So investor behavior is evolving too. And institutional buyers who relied on cash to move quickly may pivot towards structured debt to enhance their yields. So for rental focused investors in Texas, DSCR loans are gaining traction. And there's fixed rate structures that improve predictability, but there's liquidity preservation that's going to improve your portfolio resilience. So let's look at the affordability remains the core constraint to moving the market forward. And despite improving rates, Texas affordability is pressured also by elevated home prices as compared to about 2019 year eras. But property tax burdens have increased and insurance is volatile, particularly in coastal markets. And HOA fee growth in suburban developments is stinging a little extra. And this means buyers must focus on the structure of their deal and not just the price, is the point. The bottom line is, though, that the cash purchases are declining because the urgency is declining. And as rates moderate and inventory rises, Texas buyers are recalibrating their capital strategy. And cash still carries negotiation strength, but financing is no longer a competitive disadvantage like it once was in the COVID era. So for borrowers and investors across Houston, across Dallas, San Antonio, and Austin, the Texas Triangle, the opportunity lives in structuring smart leverage, but also preserving your liquidity and also negotiating from discipline and not desperation. So if you're evaluating whether to deploy cash or finance your next Texas property, the decision should not be strategic, or should be strategic and not emotional. Make it strategic is the point. Please visit Bill Rapp online to figure out how to get a hold of me. Love to talk to you further. Have a good day.